2, 1, start. Good day to you. My name is Perlman, and I want to welcome you to the Digital Financial Services Observatory webinar, coming to you from Columbia University in New York. Today we're going to talk about Bitcoin, blockchain, distributed ledger technologies, and financial inclusion. And judging by the number of people that have registered for this webinar, it's a particularly hot topic. We have participants joining us from all around the world, all the way up to Indonesia. So welcome to everybody. So the agenda for today, we're going to look at the observatory, a quick advertisement, the rationale for the webinar, global challenges in data, blockchain-related solutions, components of blockchains, implementations worldwide, specific uses in financial inclusion, and some legal and regulatory issues. We're going to have a short Q&A at the end of the webinar, so if you could hold off from posting your questions right till the end, the moderator will open up the question and answer facility towards the end of the webinar, which should last around about an hour. So, very briefly about the observatory, we house at Columbia Business School due to a generous grant from the Bill & Melinda Gates Foundation. We look at the policy, legal, regulatory issues around digital financial services. We host a number of webinars and tables. And we have a summit coming up on June 8th and 9th in New York on DFS and emerging payments. So you're very welcome to attend. A number of commentaries about new laws and regulations, and we have close collaboration with industry and regulators and standard setting bodies around the world. Just on our webinars, you'll see there's quite a range of webinars that we're hosting. If you go to dfsobservatory.com, the next webinar is on payment systems, introduction to and a refresh on payment systems, and one on money laundering, and then digital ID, and then security in mobile applications relating to DFS, and a number of others. Please go to dfsobservatory.com and you'll see the times and dates and ability to register. So, on to today's session. So, looking at blockchain, Bitcoin, this is how one perspective can be portrayed. We're not going to look at prime numbers. This is going to be a primer on a very important and evolving technology, which literally billions of dollars are being invested to as we speak, and its implications for financial inclusion. So why is there a need for this investment? Well, we have a global challenge, how to access and store growing amounts of data securely, faster, cheaper, for the benefit of all. What's the data? Well, it could be anything really. Assets, property, ability to vote, new forms of identity, financial data, contracts, digital rights, settlement information in payment systems, and a whole lot of others. So here's how data is currently mediated, or financial transactions for that matter. It's centralized. So there's a single point of failure in the middle, or a single source of data repository, and everybody has to connect to it. That person in the middle, or the entity in the middle, is usually a trusted party. Similarly, data is also stored in silos. So you have multiple data sets where people have to have APIs to connect to one another. The bank needs to talk to an auditor, to a person, to the tax authority, to the financial intelligence unit. Terribly inefficient and multiple points of failures, and also can be hacked. Even worse is in some areas there are no digital forms of storage, it's just paper records. So it's a global challenge because all this data is either centralized in silos, it's a single point of failure, stored in incompatible systems, out of date, vulnerable to hacking, inconsistent formats, inefficient, expensive, error-sensitive, and in paper form. So, solution is something called the blockchain technology, which in summary just takes all the centralized data in silos, and it's almost everybody shared. And this is a very democratic methodology. So what that is decentralizing the data from the methodology on the left to the methodology on the right. So everybody sees the same data simultaneously rather than relying on the person in the middle on the left, who is the single source of the information and repository, and potentially the single point of failure. So all this is done in what's called a distributed ledger on what's called a blockchain. Lots of terminology. We're going to get into that. Seeing it another way, all those entities are now linked on this blockchain, which is the blue circle linking all of them. So there are no silos, there are no APIs, there's no single point of failure. And this is done very efficiently and uniformly and securely. So this blockchain, where did it come from? Well, the concept was introduced in a 2008 paper by somebody who called themselves Satoshi Nakamoto. Now, we don't really know who Satoshi Nakamoto is. Lots of people claim to be Mr. Nakamoto, but as yet hasn't been clearly identified. But created a revolution. So he or she created this concept of what's called bitcoins and blockchains. The blockchain technology is a distributed ledger. So in other words, everybody shares the ledger. The data is shared and created through a process called mining. It's secure with encryption. Instead of one person being the central party in the middle, it's democratized so that consensus is needed to add information to this ledger or database. And data is stored in what's called a block, so hence the term blockchain, and everything is joined together in a chain. The other portion of the paper is something called a Bitcoin, which is a cryptocurrency. It's a digital currency that's encrypted. You need digital keys to purchase and sell these cryptocurrencies. So users mine these bitcoins through solving a cryptographic puzzle, and there are maximum of 21 million bitcoins that can ever be mined according to the thesis in Mr. Nakamoto's paper. And from 2008, 2009, when it really started emerging, it was literally fractions of pennies on the dollar for a Bitcoin. Now, $1,200 as of today, thereabouts for one Bitcoin. And there will be lots of copycats. So lots of people have taken the technology paradigm and created their own cryptocurrency coins, for example, Litecoin. And Bitcoin is becoming a means of payment around the world. There's lots of, we'll go into the contentious nature of its legality and policy, regulatory policies around it. But to put a fine point on it, some countries like Japan now accept Bitcoin in retail environments. So putting all these technologies and terminologies in perspective, here's the hierarchy. So at the bottom, you'll see Bitcoin. That's powered by the technology blockchain, and that's part of the ecosystem called distributed ledger technology. So there are some other blockchain type technologies where the data is distributed, but for the purposes of this webinar, we're just going to have one example of blockchain being a distributed ledger technology. But the term of art that's emerged is distributed ledger technology to explain everything in the ecosystem. So core concepts of blockchain: it's a type of distributed ledger. Data is stored in sequential blocks, as I mentioned. Cryptographic keys. It's tamper evident, which is very interesting, so that if somebody tries to tamper with this information, will immediately become evident to everybody. And as I said, it's democratized, because instead of one person saying yes, no, add the data to the database, ledger, blockchain, you need consensus by everybody who the data has been shared with. And if that consensus is lacking, the data isn't added to the blockchain. So let's go to it in a little bit more detail. So the distributed ledgers are replicated through what are to what are called nodes. So all those dots on the right-hand side below the B, those are nodes on the blockchain. They all have equal copies of the data, which are stored in blocks. So there's no centralized entity processing and controlling the data. It's disaster-proof. So if one node fails, there are lots of others to take over. So again, no single point of failure. There are various types of blockchain, of course. We won't get into the great detail on that, because that's a webinar in of itself. But for the purposes of today, you've got permission or permissionless blockchains. Very simple. If somebody gives you access or doesn't give you access, public or private. So the Bitcoin blockchain, for example, is a public blockchain, and a lot of the financial institutions developing their own blockchains are, as you can imagine, private blockchains with permissioned attributes. So how do you add data to the blockchain? Well, the data is stored in blocks, so those black blocks in the image. The new data inputs, which are the yellow block, would be added to the blockchain through the process of mining. So as data is added to the blockchain, the chain grows, and if anybody tries to tamper with that data, everybody knows about it almost instantly. So to add data to the blockchain, you need what's called private and public keys. And just to put it in a traditional context, there's a check. There's your signature that's created through your private and public keys, and you got the recipient public key in the middle, and there's your public key. So that's the context. The signing with keys serves multiple purposes. The nodes, which are the points on the blockchain, people who've got copies of the blockchain at any one time, they must sign the new data to confirm additions to the block, and that's consensus. So it also serves to confirm the identity of the parties, and also importantly encrypts or hashes the data on the blockchain. So the hashing is a very simple way of describing encryption. It also happens to compress the data so that all the copies of the blocks are compressed, so it doesn't become this ginormous file that needs to be stored in everybody's computers. It is big, but not enormous because it's compressed. So secure, very, very difficult to break the encryption. And there are, to date, the Bitcoin blockchain has not been hacked. The exchanges where you can convert the Bitcoin into real fiat currency, of course, have been hacked, but the blockchain itself that powers Bitcoin has not been hacked. So this is a very, very secure technology. Again, to add the new block, if somebody wants to add new mined data to a new block, so mined data meaning new data that's been created and somebody wants to share it, the majority of the nodes on the blockchain need to okay its addition. So each blockchain can have various rules. These are consensus rules, they're called. But to put a fine point on it, no consensus means no addition to the proposed new blocks. And if that happens, you're on your own essentially with that data, that little lonely purple block. So how does it all fit together? Let's start from the top left at start. So somebody who has data, that's a person on the blockchain, a node as we call them, wants to add data to the blockchain. So the request to add that new block is broadcast to all the nodes on the blockchain. So the nodes on the blockchain check the new data, and they check its veracity and sign the consensus with a digital key. They verify or agree to the new data. The new data is added to the blockchain, and very simply, the block addition is complete. This, depending on the blockchain, can take a while. The Bitcoin one, for the moment, takes 10 minutes. The newer, because that's 2008 technology, the newer blockchain varieties are far, far faster than that. To the extent that for financial transactions, they need to be the equivalent of say, MasterCard and Visa, who do these transactions in the hundreds of thousands per minute. So that's the nirvana. That's what you aim for with this blockchain technology. And so the block gets added, and very simply the process repeats. So the blockchain awaits a new block request. So another interesting component to the blockchain technology is something in a particular blockchain called Ethereum, and these are things called smart contracts. And we'll go into the legality of these, but these are essentially legal terms that have been added to a blockchain, so that the paradigm of if this happens, then that happens. So in the middle, if something happens, if the agreed amount is received on time, then designate the buyer and pay the seller. And that's all self-executing and automated. And this has got varied applications. We'll give one application, proposed application in financial inclusion. But this is a very exciting development, and a lot of policymakers have taken notice of this. And in fact, as we'll see, some laws have been passed to recognize these smart self-executing contracts as the functional equivalent to existing paper and similar digital contracts. So some selected blockchain initiatives, and again, there are many. That's a separate webinar in of itself. But R3 Consortium is a blockchain startup backed by 70+ banks and insurance companies for settlement and trading. It trades digital assets on a private network. This is very, very big. NASDAQ, it's used blockchain to complete and record private securities. It even has its own blockchain technology evangelist on board. Australian Stock Exchange is developing a private blockchain with the US-based digital asset for post-trade equity settlement. And for share issuance and voting, Estonia has its own blockchain. Lots of initiatives. I encourage you to go online and Google blockchain initiatives. You'll find multitudes. So financial inclusion applications of blockchain technology. Micro insurance for small farmers. So this is going to integrate all the concepts we've covered: smart contracts and blockchain, for example. So in this slide, there's a farmer. The farmer, a small farmer, could be anywhere, gets a smart contract through a micro insurance company. Selling these micro insurance contracts, and this is weather related. So the trigger really would be drought. So if there's drought, then pay the farmer. So this entire process is automated on the blockchain through the smart contract. So the smart contract really says, then have an external source that tells you what the weather patterns are, and in fact, quite interesting technology. You'll see those two base stations to the top left of the image, in between the two suns. That can right now tell you if there's been rain. So if there's interruption or attenuation between the GSM mobile signal in a particular area, this will indicate that there's been some fog or rain. If there's no attenuation in the signal, it means that there's been no rain or no that there's a potential of drought. And this is all automated and external input into the smart contract blockchain. So at the end of a period within the contract, the smart contract, there's a determination that there's draft. So these trigger the smart contract terms automatically, and there's a payout to the farmer, and he or she gets a notification on their phone. It could be a G2P payment from a ministry or some other body that, in addition to the microinsurance payout, but essentially the entire process is automated, and their mobile money account or bank account is credited as within the terms of the smart contract. So another big use of blockchain is its application, Bitcoin. So there's a company called BitPesa, which was one of the first to recognize the link between financial inclusion and remittances and blockchain and cryptocurrencies, and it sends value via Bitcoin rails, as we call it. Rails is a sort of payment technology term versus banks, SWIFT, Western Union. And this is a screenshot from their process. Essentially, what happens is the user buys some bitcoins and sends it to them. BitPesa then charges a 3% transfer fee and converts it, say, in this example, to Kenyan shillings and sends it along to the recipient, say through M-Pesa or whatever other system they may be using. Well, right now I don't believe they are using M-Pesa, but whatever other currency. So another application is on interoperability or settlement between parties. So within the mobile money DFS ecosystem, you'll know that interoperability is very limited. Only a few countries have it. And putting together the systems is usually a complicated negotiation, may or may not involve a switch. Right now it's bilateral. So on the left is the traditional method of clearing and settlement, where you have a central counterparty. This has large associated costs with it, which for microtransactions in many countries can be quite a prohibitive addition to the overall cost, so and really impede the ability to do proper and efficient and cheaper interoperability. So there are risks attached to this. Essentially, you need to know that the person that your counterparty, at the end of the day, if you're using a settlement system on a switch, is going to be able to settle with you and essentially pay you all the money that's owed once you've netted all the amounts that are owed between the parties. Again, the fees might be prohibitive. You might have switch fees and you might have interchange fees. So the nirvana, and this is really a nirvana rather than an existing technology, is the potential for clearing settlement via blockchain on the right-hand side. So what's interesting about it is the ability to do a real-time liquidity check. So let's say all of these parties were on a blockchain, and Airtel wants to send money to Access Bank or to M-Pesa, for example. Again, this is all stylized. It doesn't exist at the moment. Each party can dip into the other's financial position purely for the purposes of that transaction. So they're not seeing the wider financial position. They don't see exactly how much money each counterparty has, but they know that for the purposes of the settlement transaction, there is enough money. So that's the permissioned component to, say, a private blockchain. You give them permission to view just a little bit of information, just enough to complete the transaction. And this is, of course, cheaper because you don't have a central switch. Everything is shared in almost real time, and certainly faster. And indeed, while this is not in place with the parties on the picture, it is currently in place and being tested around the world with other types of blockchain. In fact, is one of the main uses of blockchain, that is for clearing and settlement. So another potential use, and in fact this is a company called BankQ, which is creating IDs on the blockchain, primarily for users such as refugees and bank other customers. They take a selfie and load additional identification onto the blockchain, and this information stored on the blockchain is accessible with the user's consent. Again, this is the permission component of a blockchain. This could be a public blockchain for use in financial transactions and identification needs, and together with other social information, a profile is developed of the person and used for verification purposes as a sort of a private ID. This is not a national ID, but having said that, there are countries that are exploring using the blockchain for IDs. So let's go into some legal and regulatory issues. So taking all those issues that we and technical components that we spoke about and piecing them together to see the policy implications, the legal implications, and how regulators and courts are dealing with this very, very new technology as we speak. So these are the open regulatory issues. And again, this would be both a developed and developing world issue or set of issues. It's very, very new, and regulators are struggling to keep up with this. I'm glad to see some regulators are on this webinar. So let's just distinguish between the types of regulation. So we've got Bitcoin regulation versus blockchain regulation. Often thought of being interchangeable. So if you speak of Bitcoin, it must be blockchain, and blockchain must be Bitcoin. It's not. They have different risks. So put a fine point on it. Bitcoin is a currency. It has currency type of, or cryptocurrency. It has money laundering implications. It has systemic risk implications to some degree, versus an infrastructure issue around blockchain. And if I can see the infrastructure, say the infrastructure issue is essentially around say contracts and the technology used, then that makes the distinction between the currency and Bitcoin, and blockchain the infrastructure. So within the Bitcoin open issues, open regulatory issues, really regulators, judges, policymakers have all struggled with this because it's new, and they vary across jurisdictions. So there could be recognition of Bitcoin as a currency, so a fiat currency as money, an asset class, a commodity, or quite frankly all of them or any combination of them. And there's a potential for a bit of regulatory arbitrage, and in fact that's what happened in a lot of jurisdictions. Each regulator says, no, I have jurisdiction over it, and then what you get is a bit of coordination failure. And in fact, then the judges weigh in and say, well, look, I think it's money. So it's all over the show, depending on the country. And some of the big issues, of course, is how to apply consumer protection measures, because this is all on a blockchain, not necessarily visible, and also how to apply anti-money laundering measures to Bitcoin. Of course, when Bitcoin is a cryptocurrency, but when you pay real fiat money to interchange it between Bitcoin and the fiat currency, usually through an exchange, a Bitcoin type of exchange, then your normal KYC AML measures really need to be applied, and that seems to be the point of reference for many regulators, is that Bitcoin with Bitcoin, you need to apply existing AML measures as best possible. So just to some recent headlines about why it's all over the show. Top one, this one from April 15th. Belgian Minister of Justice plans to crack down on Bitcoin activity, whereas, as I mentioned, in Japan, they've just legalized it, so the Bitcoin law has gone into effect. Central Bank of Kenya warns of Bitcoin risks. Russia eyes legal recognition for Bitcoin, and Bitcoin in India may boom. Same with many other countries, you're going to get various types of headlines. So it's still evolving. There's no consensus, so to speak, on how to handle Bitcoin as a currency. So if we could look at the legal issues around blockchain, that seems slightly clearer because there is some basis for it in terms of existing electronic commerce laws. But the legal issues of this is the veracity of the property asset rights embedded in the blockchain. Do they exist? What's the legality of smart contracts? Where's the place of contracting using a blockchain? So, for example, is the place of contracting the time that the person who initiated a new block that has the smart contract in it, is at their place? So is it Jakarta, where it was initiated, or is it in Nairobi, where the last node gave consensus? So where's the place of contracting? Of course, you can specify that with, in the smart contract, but what are the default rules if the smart contract doesn't say that? What's the time of contracting using a blockchain? Again, is it where the initiator started, or is it the time that the last person, the last node on the blockchain said, yep, let's add that block? The time implications might have, the time issue might have implications for contracts that are time sensitive, say put options or some buy options for shares or anything else with a time component to it. And what's the chain of legal liability? Something goes wrong. What happens if the smart contract, which is a bit like nuclear fission, once you start it, it can't be stopped because it's self-executing. What happens if something goes wrong and external input is incorrect? How do you stop it? And if you can't, where do the damages lie? Is it the person who coded the smart contract? Is it one of the participants? Is it one of the nodes? Again, a lot of those issues are still evolving. This is very, very new. So similarly, some regulatory issues around blockchain and distributed ledger technologies. Again, there's various approaches worldwide. Is there a need for a blockchain law? Does one recognize the smart contracts as real notarized contracts? Legal recognition of property rights in a blockchain, legal recognition of property, how to apply consumer protection measures, how to apply anti-money laundering measures, and use of identities registered for one jurisdiction and used in others. Now, very interestingly, about 2 weeks ago, the state of Arizona in the US passed a blockchain law, literally a law specifically on blockchain and smart contracts, and defined the blockchain in very interesting terms, and also defined smart contract in interesting terms. I mean, the lawyers might not necessarily agree with it. Certainly, technologists might necessarily agree with it. The goal really with legal with drafting of laws is to be as technologically neutral as possible. In case something changes, you want to be as generic as possible. The Arizona law, though, it's got a very welcome definition of blockchain. The definition would not necessarily make many technology aficionados happy, because it uses terminology that is very technology that's very specific. So you want to be as generic as possible in drafting. So just on that law, and this could be a basis for many other blockchain type laws around the world, and I'm mentioning it, is it essentially says that anything, any property, and I use that term loosely, not a house or apartment, but any property, any asset that's referred to on a blockchain has equal rights to any other contract, any written contract. So it recognizes any blockchain contract, specifically the smart contract. What it does, and this is very welcome, is say, look, these are the default rules, we recognize it. But if you want to have a carve out within that contract, you can say, look, blockchain technology doesn't apply to this particular contract. So, there's a carve out for circumstances where blockchain technology wouldn't be appropriate for contracting. Again, the policy implications and applications are all over the show, but mostly heading in a positive direction. I would say if you're a blockchain aficionado, British government grants millions to blockchain technology research. Reserve Bank of India investigates blockchain for financial applications. Dubai government signs MOUs. China's central banks involved. South African Reserve Bank. So really what's happened here is not only have regulators, specifically and mostly central banks and financial authorities, embraced the concept of blockchain as something to regulate, but they've embraced it themselves. So as I mentioned earlier, for clearing and settlement, blockchain is being used. A lot of these central banks are in fact using blockchain for just that, for possibly to replace their real-time gross settlement systems with blockchain technology. And in a lot of ways, how they're doing this is through a concept called the regulatory sandbox. A lot of you might have heard of this. Here's a screenshot from Malaysian Central Bank. So what they say is you can build anything that you want, sort of on a fintech basis in a safe environment with clear boundaries and safeguards, where the consequences of failure can be contained, and they can relax any of their rules. So, for example, this is being applied in Singapore and the UK, who've opened up the FCA, Financial Conduct Authority, have opened up their own sandboxes, and allowing a limited number of fintech companies doing blockchain work to essentially experiment with blockchain technology for financial services without the full bore of regulations applying to them. So again, within this sandbox environment. Very interestingly too is the Monetary Authority of Singapore has also got a sandbox, and this is a very busy slide, but essentially shows much of the process, their thinking, which I can summarize to say, well, come play in our sandbox with your technology. We'll limit upfront what you can do so that there's no systemic implications, but you are very welcome to come play and test your technology. So looking around a lot of the countries that are doing mobile money, DFS, this again is not front and center per se, and maybe should be. And I think more to the point, and certainly in my travels, many of the regulators aren't aware of blockchain technology or Bitcoin or however they interchange the terminology. So if you're not aware of it, you can't really regulate it, nor can you essentially boost it through your own initiatives like sandboxes. So I think that's the next phase within the financial inclusion space is for capacity building for regulators. They certainly will hear of it from innovators and fintech companies starting up within their countries, and they really should be ready to embrace this if they want to but certainly to understand it, and really the best way of doing that is through this emerging sandbox paradigm that many regulators around the world, in some developing and developed countries, have embraced. So that for now is the presentation. The moderator will now open up the session for text questions if you have any. So we'll wait for that. Thank you. So you're very welcome to ask any questions. We don't see any as yet. So we've got a question on DLT initiatives around the world. Again, there are many going from shares to property. In Ghana, for example, the government there is experimenting with putting property registers on the blockchain, so that the paper-based or insecure databases are removed and replaced with something that's persistent. And that seems to be a good way of using the blockchain, say for property registration, because then you can check your property. The tax authorities have got access to it. If you're getting a loan against your property, it's easily accessible. So property is certainly one. I mean, physical property, as in houses and apartments or flats, are being used. Oh, I've got a question. Just been told that this topic will be covered in a seminar, a conference for Caribbean stakeholders on April 27th and 28th. We can post the link. It's a very long link. Obviously, I can't read it out, but we'll post the link on the website so you can register for it. It's done under the auspices of the Caribbean stakeholders and the ITU. So thank you for that. Russia, I've got a question on Russian use of blockchain. Russia's eyeing of blockchain. That maybe there's a two-part question on Russia's use of and attitude towards Bitcoin versus Russia's eyeing of blockchain. Well, the Russian view has changed, it appears, and I use that word appears strongly because the headlines are not clear. There was a headline report last week that said the Russian Central Bank is going to okay the use of Bitcoin, but that's not clear. So there was a pushback on that report, but certainly, as with most central banks, they are eyeing blockchain. The slight issue with Russia, of course, is that it is currently subject to sanctions, and if you're on a blockchain, you're essentially sharing technology. And there was a report of one of the major blockchain initiatives not allowing the largest Russian bank onto its blockchain because of the sanctions issue. So internally, blockchain is maybe used, but internationally there appears to be, and again, this is subject to more reports as they emerge of exactly how the sanctions issue is going to be dealt with, if at all. Okay, there are other questions coming through. So, an interesting question on how do you create a cryptocurrency. So, as I said, within the Bitcoin component, there are a number of copycat cryptocurrencies. And in fact, there are dozens upon dozens. So it's not very difficult to do these things. You can create, some sort of currency. Whether or not it's legal is another matter. You can put all the parameters. You can say, look, I only want 20 million coins within my currency to ever be released. But ultimately, that people need to use it as a means of payment or a means of exchange, or use it within with the parameters of some fiat currency. And there you will touch on the regulators' domain, and they'll say, look, have you got money laundering processes in place to check who's buying the stuff? Is there a velocity check that nobody's buying too many, using it for money laundering? But ultimately, each jurisdiction will have its own rules. Whether or not you want to transfer it to another country, which of course you can, because it's just computer code, is another matter. So where it lands, there might be some jurisdictional issues. So ultimately, you can do it. It might not necessarily be banned. The concept of creating a cryptocurrency might not be banned within a country, but certainly its trading might be restricted or even banned altogether. And if that isn't restricted or banned, then certainly the money laundering components would arise. Okay, there are some other questions coming through. So there's a question on the laws relating to smart contracts. Again, that's an evolving issue. The best reference I have is a lot of the U.S. states, which have been very progressive in doing this. So interestingly, there's a bill in the state of, again, Arizona, which is very pro-gun. They've got a proposal to say that no gun registries can ever be put on a blockchain because it's visible. But a lot of the U.S. states have got what I see as the first blockchain type laws. But having said that, as I mentioned, there is a basis for them. These are the e-commerce laws, which do give recognition to electronic contracts. So give functional equivalence between a written contract and a digital contract. So now we're extrapolating to the blockchain and smart contracts, but ultimately there are existing laws on the books around the world because they all use the 1996 UNCTRAL model law on e-commerce as the basis for the e-commerce law. So it's not like there needs to be per se a specific blockchain law. There are existing statutes around the world on e-commerce that could be used. A lot of these laws are quite dated though, so maybe refreshing it with some blockchain inclusions and smart contract inclusions would be useful. But again, if you are a regulator on this webinar, I would caution against using specific technology terms, because as fast as an innovator can innovate, your definition of some technology on which your law is based will be outdated pretty soon. Question on how does one prevent users from sharing passwords or tokens? Well, that's a very good question, and been asked especially in the financial world. Biometrics would be one way of preventing a token or password from being shared. So I alluded to the fact that blockchains are democratized in a sense, but for financial transactions, you do need permissions. And what's happening is there, believe it or not, is a sort of a trend towards trusted parties on the blockchain who would mediate some of the transactions, which goes really against the whole paradigm of doing away with intermediaries, the people in the middle. But there's some blockchains, especially as I said, for financial transactions, that are going to use these trusted intermediaries. Many of them, not just one, and those, because they have full control over the blockchain, would need a higher level of security, and certainly that would be controlled through biometrics. So use iris or some other method to sign in addition to the blockchain. And to that point, wouldn't biometric information then be accessible to all the nodes, thus opening further risks for ID theft? Well, I'm talking more about the keys being locally available for whoever's signing it. So the biometrics would be done locally and wouldn't be shared on the blockchain. It would be part of their private key. So the private key is never shared. It's a public key that's shared. So your iris scan would be essentially unlock your private key. Thank you for those two questions. So, question on smart contracts, place it started and lessons learned up to now. Well, that's a super interesting question. Thank you for that. Look, I've given you a very broad overview of this technology. It's not all fun in the sun. There has been some issues. Again, that's a very long explanation, but in the purposes of this question on smart contracts, what are the lessons? Well, last year, one of the blockchains based on something called Ethereum. Ethereum was the first to include this smart contract paradigm. Bitcoin, for example, doesn't have a smart contract component to it. Ethereum does. So what happened was somebody figured out how to, and I use this term in a very advisedly, manipulate, if you will, the Ethereum blockchain, specifically some of the smart contracts. And there was a potential for loss of value. I think up to about $60 million was on this blockchain, the financial blockchain. And the people on the blockchain had to make a decision, excuse me, on how to deal with this. And essentially, they went and undid these transactions that caused the vulnerability, which violated, in inverted commas, one of the components of a blockchain, which is you can't change things, otherwise known as immutability. So everybody thought, well, everything is immutable. That means can't be changed. Final. Well, the Ethereum example disproved that. So there are issues. This is evolving technology. You need to kick the tires on the technology, hence all the sandboxes from regulators. But you know, it is a positive trend, as I say. Now, if you recall, I spoke about that Arizona law, and it used very specific terms in it. And one of the terms it used was, well, to define a blockchain was immutability. So for some reason, and this thing was only passed a few weeks ago, they didn't get the memo that immutability is no longer a given within blockchain. What is a given is tamper evidence. So you can see that somebody's trying to tamper it. So it's very difficult to change things, but you can certainly see if somebody's tampering it with it. So the whole immutability component, and this is why I didn't mention it because it's in the definition of a blockchain, is because the Ethereum vulnerability changed everybody's thinking of immutability. So again, do a due diligence if you are writing laws, regulations around blockchain as to what the state of the art is. That if immutability isn't still relevant, don't include it in your definition of blockchain. Okay, there's a basic question as they phrase it. What is the duration within which miners dig and approve the information for the data block, and how many miners are required to approve the data block? Now, that's a very good question. So the short answer is it depends on the blockchain. So within the blockchain, Bitcoin blockchain, right now it's 10 minutes for the nodes to get this information and to okay things, which is obviously too long. As I said, if you want to be Visa, MasterCard, you've got to do hundreds of thousands in a couple of seconds or minutes. So this doesn't really work for high stakes financial transactions where you've got trillions of dollars being settled every day and needs to be done quickly. And so how many miners need to approve? Again, it depends on the blockchain. It could be a majority or any other set value within the blockchain code. Depending on who is involved in the blockchain, they can at some stage change that those metrics. That is, who needs to okay things. There is something, as I said, Bitcoin 2008 paper. There is a bit of a civil war, if you want to call it that. Some people have termed it that within the Bitcoin community. But people saying, look, it's 2008 technology. We need time for an upgrade. And there's this debate. There's a very intense debate on how to upgrade Bitcoin to make it faster and to change the consensus rules. So the new, in inverted commas, proposed Bitcoin technology is called Bitcoin Unlimited. So the proposal is to have Bitcoin, your classic type of Bitcoin, versus a new type of Bitcoin called Bitcoin Unlimited, and who knows how that will work out. That's been going on for quite a while now. But to put a fine point on it, you can change the rules around the blockchain, and as to what's needed to change it, what the block rules are, etc., etc. Okay, some other questions coming through. Okay, very good question on the strength of encryption of the blockchains. So to summarize the question is, well, what's the strength of the encryption, and is there a stage where the stuff can be broken? So people get super duper computers and can find out other people's private keys. Now, it actually is, I was reading last week, there is this initiative, and it requires a computing power of literally hundreds of thousands of computers. I think they call it the Bitcoin Collider, sort of as a analogous to the Hadron Collider that looks at splitting atoms and finding quarks and all good things. I think it's out in Switzerland. So using massive computing power to break the code. And based on the current permutations, yes, it's going to take quite a while to break the code and find people's keys. By that time, quite frankly, however long it takes, because it doesn't look like it's happening anytime soon, the information might be pretty useless. Having said that, you also need to take into account the fact that advances in encryption and quantum computing might change. So if you look at maybe 10 years from now, they're going to be quantum computers or many computers joined together that have got the aggregated computing power. Yes, take that into account, but then also change the existing information encryption technologies on the blockchain. So it's not a static thing. You can change it. Again, it depends who is involved in it. But in 10 years' time, is that information still valuable and is it worth going to that trouble? Well, it's up to the people that run the blockchain and those who own the information on it. Okay, so these are really good questions. Thank you very much. Okay, I think there are some questions that kind of repeat the previous questions. So I think, seeing that we're on the hour, we're going to close the webinar. And I want to thank you again for participating. The webinar has been recorded and will be online on the DFS Observatory website, which I encourage you to go visit. There's a lot of good information there, a lot of hard work, especially if you're looking at laws and regulations and policy papers and various other things. It's all there. And if you're in New York or want to come to New York, June 8th and 9th is our annual summit. We have 55 top quality speakers from around the world. It will be hosted at Columbia University in New York. And if you are planning to join us for another webinar, May 2nd, we've got a webinar on payment systems. So you're very welcome to go online now and register for that, and also register for the DFS Observatory newsletter, which will seamlessly update you with all our activities. So with that, we just passed the half hour and the hour mark for the webinar. I want to thank you again and have a good morning, good afternoon, and good evening wherever you are in the world. Thank you very much.